Let's say that you have a partnership and you are a partner of the partnership. If you are paying wages, so you have employees, you cannot be on the payroll. So you cannot receive a Form W-2. The IRS says that a partner in a partnership cannot also be an employee. So the alternative that you do is you pay what's called a guaranteed payment. A guaranteed payment is essentially the business simply writing a check. So if the salary for that partner is intended to be $120,000 a year, instead of it going through a payroll processor and having federal income taxes, Social Security, unemployment, all of that taken out of the amount that is going to the employee, instead, the full $10,000 every month, because $120,000 divided by 12 months, $10,000 will go to that partner in the form of a guaranteed payment. The guaranteed payment then, instead of showing up on a Form W-2 like it would for an employee, instead it shows up on the K-1 for that partner. There is a line for guaranteed payments, and it will show up there. That tells the partner how much of it will be taxed. Now, one of the main differences of not being able to be an employee if you're a partner is basically who is responsible for paying the self-employment taxes. So as an employee, half of the self-employment taxes are paid by the employer, or if it's a partnership, by the partnership, and half are withheld from the wages of the employee. The self-employment taxes are 15.3% generally until you hit certain limitations. But at $120,000, essentially someone is paying 15.3 of that in self-employment taxes. So by having a partner receive a guaranteed payment instead of being on the payroll where half the partnership is paying it, instead it shifts the obligation of those self-employment taxes to the partner. So the partner is paying all 15.3% when they file their tax return. If you want a partner to receive the same net amount after taxes as they would if they were an employee, you essentially have to gross up the wages that they're receiving. So instead of receiving $120,000, they'd receive a higher amount based on whatever the math is, and then you'd pay them that guaranteed payment. They'd pay the full 15.3% on their own tax return. Now, the other piece that a lot of people miss is that because a partner is now receiving guaranteed payments instead of being on the payroll, they're not having federal and state income taxes withheld on the payroll every time they're getting paid. So now they have the burden of making estimated tax payments. So that's what withholding is. It's essentially making sure that the government receives their share of taxes so you don't get to the end of the year, spend all your money, and not able to pay your tax burden. So a partner who does not have that withholding is obligated to make estimated tax payments throughout the year. The first installment is due on April 15th of that year, the second on June 15th, the third on September 15th, and the last one is due January 15th of the following year. So if you're a partner and you're receiving guaranteed payments, you want to make sure that you're having your CPA help you calculate how much your estimated tax burden is for the full year and having you pay 25% of that in each of those due dates. I'll see you guys in the next video.